Module 8, Petty Cash. Establishing responsibility. Establishing responsibilities is a crucial element of internal control within a business or organization. This involves assigning specific tasks and duties to individuals or departments within the organization and establishing clear lines of authority and communication. The purpose of establishing responsibilities is to ensure that everyone in the organization understands their role in maintaining and safeguarding the organization's assets and that they are held accountable for their actions. By clearly defining responsibilities, businesses can reduce the risk of errors, fraud, and misuse of resources. The process of establishing responsibilities typically involves the following steps. Identify the critical areas of responsibility within the organization, such as financial reporting, cash handling, inventory management, and information technology. Assign specific tasks and duties to individuals or departments within the organization based on their skills, knowledge, and experience. Establish clear lines of authority and communication so that everyone knows whom they report to and who they are responsible for. Provide training and support to ensure that individuals understand their roles and responsibilities and have the necessary skills and knowledge to carry out their tasks effectively. Monitor and review performance regularly to ensure that everyone meets their responsibilities and that internal control systems are effective. By establishing responsibilities, businesses can improve the efficiency and effectiveness of their operations, reduce the risk of errors and fraud, and ensure compliance with laws and regulations. It also helps promote a culture of accountability and transparency, essential for maintaining stakeholder trust and confidence in the organization. Bank reconciliation. Bank reconciliation is comparing the bank statement balance to the company's cash account balance to identify discrepancies. The purpose of bank reconciliation is to ensure that the company's records accurately reflect its financial position and to identify any errors or fraudulent activities that may have occurred. The bank reconciliation process typically involves the following steps. Compare the ending balance of the bank statement to the ending balance of the company's cash account. Identify any differences between the two balances, such as outstanding checks or deposits in transit. Adjust the company's cash account balance to reflect the outstanding checks and deposits in transit. Check for errors or fraudulent activities, such as unauthorized withdrawals or duplicate transactions. Prepare any necessary adjusting entries to correct errors or record transactions that were not previously recorded. Reconcile the adjusted cash account balance to the bank statement balance. Document the reconciliation process, including any adjustments or explanations for differences between the two balances. The bank reconciliation process is an essential internal control procedure that helps to ensure the accuracy and completeness of the company's financial records. It also helps to detect errors or fraudulent activities and can provide insights into the company's cash management practices. Regular bank reconciliations can help identify potential issues before they become significant problems and provide valuable information to help the company make informed financial decisions. Outstanding checks. When preparing the bank reconciliation, a company must consider any outstanding checks that needs to be clarified for the bank. Any outstanding check means that the company has not yet received payment from the company. To properly reflect this, the check recipient should add the amount of the outstanding check to the company's cash balance. This adjustment will increase the company's cash balance and reflect that the check still needs to clear. Outstanding deposits. Similarly, if a company made a bank deposit on that did yet not appear on the current bank statement, the company should consider this when preparing the bank reconciliation. To properly reflect this discrepancy in the bank reconciliation, the company should add the deposit in transit to the bank statement balance. This adjustment will increase the bank statement balance and reflect that the deposit has yet to be processed by the bank. The company must then compare the adjusted bank statement balance to the company's cash balance. This will help identify any other discrepancies between the two balances. Then, it can make necessary adjustments for other reconciling items, such as outstanding checks, bank errors, or service charges, reconcile the adjusted bank statement balance to the company's cash balance, and document the reconciliation process. Petty cash. Petty cash is a small amount kept on hand to cover minor expenses in ordinary business. A designated employee typically manages it, the petty cash custodian, responsible for disbursing and reconciling the petty cash fund. The petty cash fund is usually replenished at regular intervals, such as weekly or monthly, based on the amount of cash that has been disbursed. The replenishment process involves reconciling petty cash transactions, verifying that the receipts and disbursements are accurate and supported by documentation, and requesting reimbursement for the amount of cash that has been disbursed. Petty cash is often used for expenses such as office supplies, postage, small repairs, and other minor expenses that are too small to justify writing a check or using a credit card. The amount of the petty cash fund varies depending on the needs of the business, but it is typically a small amount, such as $100 or $200. Properly managing petty cash is essential for maintaining accurate financial records and preventing fraud. This includes having a designated petty cash custodian responsible for maintaining the fund, ensuring that all transactions are properly documented and supported by receipts, and reconciling the fund regularly. By keeping accurate records of petty cash transactions, businesses can better manage their expenses and control their cash flow. To decrease a petty cash fund, the company would need to record a journal entry to reduce the amount of cash in the petty cash account. The entry might, for example, be as follows. Debit, petty cash account for $25. Credit, cash account for $25. It is important to note that the petty cash fund should be replenished periodically and that all disbursements from the fund should be appropriately documented and supported by receipts. This will help ensure that the company's petty cash transactions are accurately recorded and accounted for in the financial statements. Allowing purchases under $25 to be processed through petty cash instead of the voucher system is an internal control measure to streamline the payment process for small expenses. Ensuring that all petty cash transactions are adequately documented and supported by receipts and that the petty cash fund is reconciled regularly to prevent fraud or errors is vital. Voucher System. The voucher system is a method of controlling and tracking cash disbursements within an organization. It involves using a series of pre-numbered vouchers or invoices to document each cash payment made by the company. In the voucher system, each cash disbursement is supported by a voucher or invoice, which includes information such as the date, payee, amount, purpose of the payment, and any other relevant details. A designated individual, such as a manager or supervisor, approves the voucher or invoice to ensure the payment is legitimate and authorized. Once the voucher or invoice is approved, a check is issued to the payee for the specified amount. The voucher or invoice, the corresponding check stub, and any supporting documentation are filed in the company's records for future reference. The voucher system provides several benefits to the organization, including increased control over cash disbursements. By requiring approval for each payment and maintaining a record of each transaction, the voucher system helps ensure that cash disbursements are legitimate and authorized. Improved record keeping. The voucher system provides a clear and organized record of all cash disbursements, making tracking expenses and reconciling accounts easier. Reduced risk of fraud. The voucher system helps prevent unauthorized payments and reduces the risk of fraudulent activity, such as duplicate payments or payments to fictitious vendors. Overall, the voucher system is an effective tool for managing cash disbursements and maintaining accurate financial records.